Hello and welcome to my ESC 301 mini literature review. My name is Yusuf Saad and I'm going to dive straight into the application of deep reinforcement learning in algorithmic trading. Jumping straight into the research methods and contexts, I'm going to explain why I chose this topic and how I went about the process of finding the three papers. Being an MSF student, I'm quite interested in quantitative finance, so I decided to start by searching the University of Toronto Experts portal, where I was able to find professors who were doing research in my field of interest. I stumbled across a Professor Sebastian J. Mangal, who had research interests in mean field games, reinforcement learning, clean energy, and algorithmic and high-frequency trading. After parsing through his different research papers, this one particularly stood out to me. It was about the application of a double deep Q network in the trading of foreign exchange triplets. I decided that it would be a good idea to use the title of that first paper as a search query for Google Scholar, and I stumbled across these next two papers. The second paper was about using sentiment analysis with DDQNs, and the third paper was about enhancing DDQNs by applying a self-rewarding mechanism. Next, I think it's important that I dive into a few key concepts and topics before I dive into the three sources. Our discussion today is around Q-learning, which is a model-free reinforcement learning algorithm that learns the optimal action value function to determine the best action in a given state by maximizing the expected future reward, or the Q value. A DQN builds on Q-learning by using deep neural networks to approximate this Q value function, allowing it to handle higher dimensional spaces, making it perfect for trading environments where there are many complex signals and factors that can be extracted. Deep Q networks are known to overestimate the Q values that are associated with certain state action pairs, which makes it less risk averse, which can be problematic in trading scenarios. A double deep Q network builds on a DQN by reducing this overestimation bias in the Q value by using two networks, one for action selection and one for value estimation. Jumping into our first source from Professor Jaimangal and some of his colleagues about the application of DDQNs in trading foreign exchange triplets. The main goal of this paper was to develop a statistical arbitrage strategy for trading FX triplets using model-based deep reinforcement learning, such as a DDQN, as well as introducing a novel approach to modeling markets called Reinforced Deep Markov Models, or RDMMs. Say you want to buy US dollars from euros. If you have access to the Euro GBP and then you have access to the GBP US dollar rate, you can trade that path instead of directly trading the Euro to USD path. In a perfect world, both of these paths are equal. However, the success of the strategy stems from taking advantage of the co-movements and reversions in the exchange rates of the currency pairs. A statistical arbitrage is not a riskless strategy. The objective of the strategy is to make profits on average, but there is no guarantee that the strategy will never deliver losses. What the RDMMs allow for is to model the market dynamics by incorporating the actions and rewards. This allows for learning both the environment dynamics and the optimal trading policy together, rather than trying to model the environment ourselves. This next paper was written largely by a team in Mexico, and they aim to apply sentiment analysis using double deep Q networks. The main goal of this paper was to investigate the application of a DDQN to the algorithmic trading of a single asset. In this case, it was Tesla stock, focusing on augmenting the agent state space with sentiment analysis of financial statement. This was facilitated largely by the Loughran McDonald sentiment list, which was a specialized lexicon used in financial text analysis that categorizes words based on sentiments such as negative, positive, uncertain, litigious, constraining, and interesting. The key innovation was incorporating sentiment scores derived from this LMACD sentiment word list applied to Tesla's annual and quarterly financial reports into the DDQN's agent space. Not only was the DDQN able to learn profitable trading strategy that was robust, but every model was also able to surpass the benchmark that was a simple buy and hold strategy, further attesting to the potential and efficacy of applying reinforcement learning to the financial domain. The study also systematically explored the effect of the length of past market data considered by the agent, finding that a longer look-back window can influence trading decisions and overall performance. Our third and final paper was by a team that's largely in China, and it was about the application of a self-rewarding mechanism to the DDQN in order to allow it to almost learn like a real person would. The main goal of this paper was to integrate a self-rewarding network that learns from expert knowledge and predicts rewards to provide more effective adaptive reward signals for the RL agent. How did the self-rewarding work? The first phase was that the model had a student brain that learned by looking at how expert traders would make decisions and what kind of results they would get. It tries to understand what makes a successful trade according to real-world experts. The next phase was that the model would compare and select the higher of the prediction of its own student brain on what the trade should be and the trade based on expert behavior. This maximizing behavior encourages the model to aim to improve its own predictions. Upon closer examination, it becomes evident that the SRDDQN agent exhibits astute trading decisions. For instance, in Figure 2, around the 690th day, the agent identified an upward trend in stock price and executed a long trade. By the 700th day, as the stock price approached the peak, agent swiftly switched to a short position. So that was a quote directly from the source. If I point this out over here, this red upside down triangle is when the agent shorted the Dow Jones index, and then it was able to predict that, and then it longed it over here. It was able to successfully predict that, and even this small change over here was able to short that and then long it straight here, and it caught this entire ride until it shorted it back up here again and then caught this tiny downturn over here. So moving on to the synthesis of the sources. All three sources utilize DDQNs as a core DRL technique for developing algorithmic trading strategies. They all frame the trading problem as an MDP, where the agent interacts with a trading environment, observes states, takes actions, and receives rewards. All the sources acknowledge the suitability of this DDQN for algorithmic trading due to its strong ability to learn from complex, dynamic financial environments without requiring explicit models of market behavior. The use of the target network with weights updated less frequently than the main Q network to stabilize the learning process and mitigate overestimation bias is a common feature of the DDQN implementation across the sources. The primary goal and market focus of the first one was to find statistical arbitrage and FX triplets. The primary goal of the second one was for sentiment analysis on single asset trading. And the third one was to implement a self-rewarding trading strategy optimization for multiple stock indices. The overall takeaway from this literature review is that all the sources show the strength of DDQNs as a fundamental DRL technique for automated trading. This is largely due to their ability to navigate complex, dynamic financial environments without explicitly defining a market model. These papers were significant to the field as collectively they demonstrate methods to enhance DDQNs by incorporating external information like sentiment analysis and self-explorative behavior. They contribute to the growing field of applying advanced AI techniques to financial markets. Moving forward, the first paper can benefit from exploring the integration of more sophisticated market microstructure models and the application of a continuous action spaces to better reflect real-world trading. The second paper can benefit from investigating the generalizability of the sentiment-enhanced DDQN strategies across a wider range of stocks and market conditions rather than just one stock. The last paper can benefit from the validation of the framework in live trading environments to assess its real-world effectiveness. Exploring the integration of macroeconomic indicators into the reward system could also further enhance its adaptability. Moving forward, all of the papers can address the inherent non-stationarity of financial markets and improve the generalization capabilities of their DDQN models to unseen market conditions, which still remains a significant challenge for the industry as a whole. Exploring the use of large language models for advanced market sentiment analysis and prediction could be a promising direction that future papers could discover. Overall, this literature review has given me a deeper appreciation for AI research and quantitative finance. It's fascinating how similar yet different the three papers were, showing how truly collaborative the industry is in trying to build on existing standards through innovative improvements. This experience has shown me that I have a deep passion for research and the progression of this field, and has strengthened my drive to continue pursuing a career in the cutting edge of technology and finance through academic discovery and experimentation. I truly hope that one day I can contribute to similar research in the near future, and I'm excited to keep reading on other future advancements that may happen in this industry. That concludes my literature review. Thanks for watching. I really hope that you learned a thing or two, and have a great rest of your day.